Hey folks, welcome back to the Rate Update with Dan Frio. Today I got a special guest. It's a person I just met, but I feel like I've known him for years because I watch every one of his videos. And I'm not kidding you. This guy is my go-to when it comes to financial markets, especially real estate. I also learned a ton from him about economics, the money supply, and a whole bunch of other things, because my goal here is to educate and inform you guys everything real estate, but also in the financing piece of the puzzle for real estate and in life in general. So welcome, Jaspreet, my man. I can't believe we got you here, buddy.
Thank you for having me on. I really appreciate it. It's an
betcha.
honor to be on with you.
So if you guys don't know him, I'm going to have clicks down below, but you have to have known him because I put him in a lot of my videos, or I at least put his context in there and links down below for his videos, because he is my go-to person. But the one question I got to ask you, and I know the answer to it, but I love the story behind it. Where in the heck did you get the name Minority Mindset?
So the Minority Mindset has nothing to do with the way you look, your ethnicity, or your skin color. It's the mindset of thinking differently than the majority of people. I felt like I always had this minority mindset, but I didn't really know it. Growing up, I was always told to be a doctor. My parents are immigrants from a state in India called Punjab. And growing up, I kind of had the real traditional Indian household. My parents said that I had two options when I grew up. I could either be a doctor or I could be a failure. The choice was mine. And I always had this entrepreneurial bug where when I was young, I tried to mow my neighbor's lawns, and parents told me not to do that. I should be studying. I did other entrepreneurial ventures when I was in high school. Then when I went to college, I started an event planning company. I did this all in secret, because if my parents knew that I was doing this business stuff, they would not be happy. And then I used the proceeds from that to go out and start investing in real estate when I was 19. And I didn't know what real estate investing was or how you invest in real estate. I didn't know any real estate investors. I made a ton of mistakes, but that's how I got started in real estate, through entrepreneurship. And then I did investing. And that's when I realized I didn't want to be a doctor. And that caused a lot of friction in my house. My mom, my dad was really angry. My mom really was furious. She didn't believe that her son wasn't going to be a doctor. It took her like a year and a half to actually believe that. Then I went to law school then, because my parents said, if you're not going to be a doctor, you got to at least become an attorney to keep some pride in the family. So I went to law school. But I didn't mind it, because if I went to law school, I knew that I could work on my business full time. And I continued to work on the business ventures I was running, continued to invest my money. And that's when I started this thing called Minority Mindset, as a way to kind of provide education and support to people who want to be better with their money, because I never felt like I had that support. And I started it as a hobby. And now Minority Mindset has grown into something a whole lot bigger. And it's been the fuel for my company, which is Briefs Media. We are a financial, well, not just a financial, but we're a newsletter company. We have a newsletter for investors. We also have a newsletter for business owners. All of our newsletters are completely free. And through that, I started, Minority Mindset, just because it's thinking differently than the majority of people. And now, kind of funny, my parents are some of my biggest supporters. So
now,
everything kind of just came full circle. So full circle. That's a long answer to your short question.
No, it's awesome. So it's like, Mom, Dad, look at this paycheck. It's as much as a doctor or whatever. So you done good. Again, I love your channel. So the reason why I asked him on here is you just heard the story. He grew up learning by hard knocks. The schooling system fails us a lot. You have kids coming out of college. I won't say kids, I'll say adults coming out of college that don't even know how to balance a checkbook. You probably don't even know what a checkbook is. So I watch your channels all the time, and I have an economics major, and I'm 57 years old, and I've been around the block a lot of times, but every time I watch your videos, I learn something. And that's what I'm trying to provide with my channel. I'm not trying to FOMO. A lot of people are FOMOing real estate or the Bitcoins or all this other stuff. My goal is just like yours. I've made so many bad mistakes that it's like, let's share those with everybody else so they don't have to experience this. So that's really my focal point on why I reached out to you, because all the content you give is basically, it's fact-based. You can look it up in books. You can look it up in economics books. You can look it up in anything. It's there. So love your channel. Keep doing what you're doing, and your parents should be proud. I'm
Thank you,
proud
man. It
of you,
really
and
means,
you do
it
fantastic.
means a lot. It
So
means a
thank you.
lot, man. Thank you.
So the first thing I want to discuss is, because my channel is in regards to mortgages and rates and so forth. It's the elephant in the room. Everybody knows, or most people should know, that the Federal Reserve's right now in the position they're controlling everything. So I guess my question to you would be, you see all these people that are saying that housing market's going to crash, 90%. And then you have on the other side the sphere, people are going to say, oh, nothing's really going to happen. I know my take, and again, I've been doing mortgages, just so you know, and you know some things about me, but I've been in the mortgage business for 34 years. So I've seen the good, the bad, the terrible, and the absolutely ugly. And now I just don't feel like it's the 2008 relived. So my question to you is short-lived, is where's your point of view on the inflation front? And then where do you think the Federal Reserve is going to play, where their next steps are going to be for the next, 6 months or a year to balance out the whole system? Because we know prices are skyrocketing everywhere, rates are going up, and the consumer prices on everything is going up as well. So your platform.
So on the topic of inflation, inflation is a problem. And the thing is, well, let's start by defining inflation, because there's a lot of different definitions of inflation. Inflation at its core means to inflate. What are we inflating? The monetary supply. And many times we point out just the last couple of years how much money we printed and the stimulus that we did, but we've really been inflating for a couple of decades now. And so what does that mean? We've been printing money out of thin air, and money goes into our economy, and this eventually devalues the dollar. Well, right now we're paying the price for the money printing that we did, and that's inflation. The price of things go up. And that's where, you talk about supply chain, or not you, but people talk about supply chain issues. Well, the supply chain issues are a byproduct of the inflation, because what happened in 2020 was nobody's working, nothing's being produced except money. So now you're producing money, you're giving it to people, and people have money to spend. Now you go to the store, you buy some clothes, the store still sells you the clothes, but no one's making more clothes because no one's working. And so now the store calls up the manufacturing plant and they say, we need more clothes. The manufacturing plant says, great, we just have nobody working. And now you start creating these supply chain bottlenecks and these issues because we produced money without producing products. So that's a byproduct of inflation, is the supply chain issues. Right. And now, how do we fight inflation? Well, to fight inflation, you got to do the opposite of what caused the inflation. If inflation is caused by inflating the money supply, the way you fight inflation is by deflating the money supply, aka pulling money out of the economy. There's a few ways that you can do that. The government can spend less money. The Federal Reserve Bank can sell off their balance sheet. The Federal Reserve Bank can raise interest rates. The downfall is all these things have a price. They have some sort of pain associated with it. Like if the government was to cut down spending, well, that means people's benefits go away. Maybe they cut your Social Security. Maybe they cut welfare. They cut some sort of government benefits in order to spend less money, because the government doesn't make money, right? The government isn't a for-profit entity. The way the government makes money is you and I get paid, and then the government taxes our income. Now, no big deal if the government is spending what they make, but that's not what they do. They spend many dollars more than what they make. That's why we have this huge national deficit. That's why we have this $31 trillion worth of national debt, because the government has spent more money than what they make. Well, in order to subsidize this spending, one of the things that they do is they work with the Federal Reserve Bank, who prints the money out of thin air and gives it to the government. So the government can spend less, but that's painful because then people get less stuff. The Federal Reserve Bank can sell off their balance sheet. That causes pain into things like the bond market. We saw a huge bond market crash actually happen here in the United States a couple of weeks ago or a week ago.
Yeah.
And then the Federal Reserve Bank can raise interest rates, because now when you raise interest rates, less dollars enter our economy. That's one way to fight inflation. But that has its own pain as consequences as well, because now when you raise interest rates, buying a home becomes much less affordable. Buying a car is more expensive. Operating a business is more expensive. Now, it's a little bit different for businesses than homes, because in America, we have a very nice privilege here that we have this thing called a 30-year mortgage. Many places around the world don't have that. Many places, countries around the world, operate in things like a 2-year or 5-year mortgage, and then they readjust. Like in the UK, I have a video coming out on this. They're facing this major property crisis because, like the United States, the UK has been facing very high inflation. Their central bank has been raising interest rates very aggressively. And kind of like the United States, the UK has become very accustomed to low interest rates. Well, unlike the United States, the UK doesn't have a 30-year fixed rate mortgage. They have 2-year and 5-year mortgages. Those are their fixed rate mortgages. Maybe you can get a 10-year mortgage, but that's more of an exception than the rule. Right. Most people have a 2-year or a 5-year mortgage. And coming 2023, there's going to be millions of homeowners in the UK that are going to see their mortgages readjust. And I forget the exact numbers, but a study said that the average UK household is going to see their mortgage payment go up by £1,200 to £5,100 per month in 2023, just because of the higher interest rates. So that's going to cause a major problem when you couple that with their inflation problems, when you couple that with their slowing economy, when you couple that with their energy problems. But that's the UK. We're here in the US.
Yeah.
So here in the US, well, higher mortgage rates also have a cost. Just look around you. We have home sales slowing, home prices starting to go down just a little bit. And now this is where everybody has a prediction of what's going to happen in 2023. And most people's predictions are as good as the garbage can that they come out of. Because at the end of the day, go ahead.
Not me. You said it, not me. So send him the hate mail. No, I'm just kidding.
Well, here's the thing.
Yeah.
Everybody's making a prediction, which might make sense, but they all have this underlying denominator where we don't know what the Federal Reserve Bank is going to do.
Yeah.
See, if the Federal Reserve Bank were to continue raising interest rates, it's pretty obvious. Home prices are going to go down.
Sure.
If the Federal Reserve Bank keeps interest rates where they are today, it's pretty obvious. Home prices are going to go down. If the Federal Reserve Bank goes out and they cut interest rates in half, mortgage rates are going to become cheaper and home prices are going to probably go up. And so that's where there's a lot of uncertainty, because now we're trying to predict not what's going to happen in the housing market, but what's going to happen with the Federal Reserve Bank. And this is where the guessing game happens. And everybody has a prediction, and most people's predictions are not based off of logic, but rather based off of their own best interests. Like, I actually just put out a video on this, but I talked to my bank manager right across the street. There was a new bank manager in there, and I talked to her about the housing market. And what she was saying is, I try to play dumb just to get more information out of people. And what she was saying is, don't worry, mortgage rates are going to fall in 2023. I said, why? She said, because no one's buying homes. And so the Fed is going to have to cut interest rates. And I said, okay. I talked to other lenders. I talked to other realtors who are saying that businesses get hurt. And they all say the same thing. Mortgage rates are going to have to fall. Why? Because my business is hurting. It doesn't make sense for mortgage rates to be this high. Right. So it's based off of this more emotion rather than logic. Now, again, this is where we can look at the logic, which is our Federal Reserve Bank here in the United States has two mandates: price stability and maximum employment. What does that mean? They're supposed to only look at inflation and the jobs numbers and then make decisions on interest rates. If inflation is high and people have jobs, then they need to keep raising interest rates. If inflation is not high and people don't have jobs, then they might consider cutting interest rates. That's what the logical answer is. But the Federal Reserve Bank isn't always logical. Right. So this is where now you start having this X factor where the Federal Reserve Bank today says that they are going to continue raising interest rates until we see 2% inflation. If they stay true with that, then yeah, you bet we're going to see home prices fall. Right. If they don't stay true with that, then we can see a reversal. That's where things become very hard to predict. Now, if we dig a little bit deeper into this, what really causes home prices to, let's just say, crash? Well, in order to see a crash, you need to see two things happen. You need a home price correction plus a lot of debt. So what does that mean? Well, today in 2022, I was reading a statistic that said that the average down payment in America is something around 6%. Now, you might have a better understanding of that because you are in the mortgage business, but this is what I was reading online.
Mhm.
And if now people have only 6% invisible equity in their homes, and home prices fall by, say, 15%, which really isn't that significant when you look at the run up in the last couple of years.
Sure. Yeah.
That means you're going to have a lot of people who are now underwater on their homes. And if people are now underwater and they face some sort of financial hardship, your income goes away, something happens, your company is going down because the economy is slowing. If we see that happen, now less and less people are going to be incentivized to continue paying their mortgage, because when you're underwater, what is your incentive to try to swim above water?
Right.
It's much more difficult. And this is where now high debt mixed with a correction can cause more of a crash, because now you start seeing an increase in supply. People just, instead of mailing in a check to their lender, they mail in the keys. People walk away, they don't take care of their homes. And so that's the concern, is if we see a not that big of a correction, I mean, a 15% correction, plus a lot of people being underwater, plus an economic slowdown, well, that could then trigger an economic crash. And you're 100% right. We don't have the same factors today as we did before 2008. We don't have the same ninja loans. We don't have the same subprime mortgages. We don't have the same 0% down payment. We don't have those same qualifications today before 2008. But what we do have that we didn't have in 2008 is an inflation problem. Because when the 2008 crash happened, the Federal Reserve Bank was able to then do quantitative easing, and they were able to slash interest rates to zero as a way to stimulate the economy. We can do that today, but it's going to have a very different outcome than before 2008, because we weren't worried about inflation. Now we are worried about inflation. And if the Fed was to do quantitative easing and cut interest rates, we can create a boom in the economy in the short term, but we're also going to really hurt inflation. And that's going to hurt regular people the most. And this is where that's where all the guessing game comes in. The housing market's going to crash. Housing market's going to boom. Interest rates are going to do this. It ultimately comes down to the Federal Reserve Bank. But all the other factors are things that we can understand now, depending on what the Federal Reserve Bank does. You can kind of see the different options that can play out. And the thing that's going to narrate it is the Federal Reserve Bank, which is why what I'm saying is this is why you need to be financially educated, understand what's happening, and be prepared. That way you can take advantage of whatever opportunities come your way.
Got it. Perfect. That was, and I even learned something on that. I didn't know the UK only had 2-year terms and everything. So when I'm watching their news and their feeds and everything else, when I see their housing market and their bond market crash like 2-3 weeks ago, I didn't know about those. I always thought, honestly, I thought basically everybody had 30-year fixed rates. So I learned something from that. So
take a look at Canada. Take a look at Canada.
Oh, okay.
Canada's property market in Toronto so prior to this year, Canada was named the biggest housing market bubble in the world.
Really?
In 2022, Toronto's housing prices have fallen by around 17%. And Canada also doesn't have a very popular 30-year mortgage. They're short terms where interest rates readjust. And interest rates in Canada are also going up. Now, the central bank in Canada, kind of like the United States, has been raising interest rates to fight inflation. But in their most recent rate hike, I believe they raised interest rates by 50 basis points, 0.5%, when they were expected to do much higher. So this got a lot of people excited that maybe they're going to stop their fight on inflation in Canada because they know how much this is going to hurt the housing market. But the missing piece to that is they still raised interest rates. Property prices are falling. Even if they didn't raise interest rates and interest rates stayed where they are, people are going to get hit with much higher mortgage payments when their mortgages readjust. And this is where you got to kind of look at what's going to happen in the coming years as interest rates either go higher or stay the same. If they stay the same or go higher, and we look at other places in the world and people's mortgage payments readjust, that's going to affect how much money people pay. And couple that with high inflation, Couple that with, well, in Europe, the energy crisis, and that starts to really take a toll on people.
Got it. Here's the question I would have is I can understand where the people that just bought within the last year could be, like you said, they put 6% down. But if you go back to like the year to year gains in properties, I just last week the new study came out and they said from I think it was September or August of 2020 to or 20 of last year to now, the average price is still up like 15%. So that's one of the things that kind of confuses me is, back in 2008, we had that buildup in people being underwater because they were taking 100% loan to value mortgages and just kept refinancing at 100%, 100%, 100%, using their house as an ATM. So unless you bought in the last, you say in 2022, a house, and you bought it previously, and say in 2020, 2021, the house probably appreciated, say 15, 20%. Some markets saw, 30 or 40%. So do you expect the foreclosures, because a lot of people are also saying foreclosures can really go out the roof at this point. But my thinking behind it is, well, unless you just bought basically this year, if you bought last year, you should have that at least 15% gain, and again, some areas have higher, plus the 6% you put down. So you basically have a 20% margin there until you're back to, par, back to zero. What's your thought on that part of it? Did we have enough appreciation? But the one thing to throw a curveball in this is the forbearances.
Yeah.
A lot of people that didn't even need it, they applied for the forbearance, thus didn't have a mortgage for 18 months. So what happens is, well, that balance builds up, and then that depletes your equity as well. So I know I just threw 15 things at you, but you understand my thinking on those? So your thought, do you see a huge foreclosure bubble coming that we kind of saw in 2010 that caused everybody they had to sell their homes at that point, where people these days really don't have to sell the majority of them like they did back then?
Yeah, I mean, if you got foreclosed on today because you can't make a payment, you'd probably walk away with a profit. It wouldn't make sense for you to foreclose it because you can just sell the home and walk away with some cash. But the difficult thing to understand, well, there's a few things. One is understanding the speed of real estate, because back when the 2008 crash happened, home prices began to fall in 2005, 2006, 2007 is when home prices started to fall.
Yeah.
But home prices didn't bottom until 2012.
Right.
And so we're talking about years of kind of downward movement before we actually hit the bottom. Versus with the stock market really started crashing 07, 08, and then it bottomed out in 2009. So the stock market is much quicker moving, and understanding that real estate prices move significantly quicker, but they move slower down than they move up. Because when you're selling your home and someone's willing to pay you $10,000 over asking, you're going to always take that.
Yeah.
But when someone offers you $10,000 under asking, you're going to say, let me keep it on the market for another 15 days and see what happens. Let's keep it on the market for another 30 days and see what happens before you decide to cut it. Because, at the end of the day, everybody wants the most money for whatever it is that they're selling. You can call it greed, you can call it desire, whatever it is. Everybody wants to get the best price. Buyers want the cheapest price, sellers want the highest price. And the thing is, so I just pulled up some numbers from a video that I did before recently. 1 year ago, in Q4 of 2021, the median price of a home was selling for around $411,000. And about a year ago, you could get a mortgage, 30-year mortgage, for under 3%, 2.8% if you had a really good credit score and you got a great mortgage. So your payment on that, if someone could put 10% down, was $1,520 a month. Today, that home is selling for around $454,000, the median price. If you could get another mortgage at 2.8%, it's going to cost you $1,680 a month. So $160 difference, assuming you could get the same mortgage. The problem is you're not getting that 2.83% mortgage. You're getting a 7% mortgage now.
Right.
And so your payments would go up not from $1,520 to $1,680, but from $1,520 to $2,718 a month,
Whoa.
which is an 80% increase in monthly cost. And so now somebody who was looking at buying this $410,000 home last year, they're going to say, oh, well, that home is now $450,000. Okay, yeah, maybe I can justify the higher price a little bit, but I can't justify that higher monthly payment. If you're that person and you're saying, I could have afforded it at a 3% mortgage where it cost me $1,700 a month. Well, $1,700 a month today is going to get you a whole lot smaller. Right. So here's the numbers. I'm going to pull that up. I have it right here. If the most you can borrow or the most you want to pay is $1,700 a month and mortgage rates are 7%, the most you can borrow is $255,000. Oof. And if you're putting 10% down, that means the biggest home that you can buy is $280,000. Now compare that to 1 year ago. What could you have bought? $410,000, $411,000. So you could start to see that what people were paying and getting a year ago compared to what people are paying and getting today, it's a big discrepancy. And this is where there is room for home prices to adjust, especially as interest rates continue to rise. And you're right. I mean, the wave of foreclosures, what's going to cause it? It's when people's equity goes away.
Right.
But you also need a downturn in the economy. You need people's jobs to go away. And this is where now it ultimately comes back to, what is the Fed going to do? How much pain are they going to be willing to endure through the economy? If they really, I mean, if the federal funds rate today, and the Fed is going to raise interest rates on November 2nd, depending on what this comes out, but the federal funds rate today is 3 to 3.25%. Inflation is still above 8%. Right. So if the Fed was to double the federal funds rate to fight inflation, the federal funds rate would still be below the inflation rate.
Right.
Now, if they were to double the federal funds rate, and let's just say the mortgage rates go from 7% to 11%, what's that going to do to the housing market?
Oh, yeah, I get it. Okay.
It would hurt it. But the question is, are they going to do that? Do they have the backbone to do that?
Right.
And that's where now everybody's guessing. A lot of people are saying, no, the Fed's not going to do that. Actually, most people are saying that no, the Fed's not going to do that. The Fed is saying that we're going to do whatever it takes. But at the back of their mind, they're hoping that inflation just starts magically coming down much quicker.
Yeah.
Now, this is where, we can guess and hope, but time will tell what's going to happen with that.
But remember I think it was last year, the year before, they made a comment and they're like, we don't plan on raising rates until 2023. And then all of a sudden it was like 6 months later, here goes. And they started that traction, and they did it. How many times this year did they do? 5 or 6?
Yeah, I don't remember
right in there.
5 or 6 right there.
What's your take for the adjustment for next week? 75 basis points, 50?
Well,
I'm on the 75 basis point.
I mean, I don't like predicting what the Fed's going to do. They should do 100 basis points if they want to bring inflation down. They probably won't do that. I think everybody's predicting 75 basis points. But some people are saying, oh, no, the inflation fight is already causing problems. They're going to start easing up. So what should they do? They should do the bigger interest rate hike, because the bigger problem is inflation, not the slowing economy. The slowing economy has short-term pain. Slowing economy means some people will lose their jobs. Some businesses will go under. If they don't get inflation under control, you risk a currency crisis, which is significantly worse.
Snowballs. Got it.
It gets much worse.